Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 17th of April. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about the uncertainties that have been surrounding the markets lately, and our thoughts on assets such as gold, oil, and equities. Well, today, let's talk about fixed income and Forex. First of all, let us take a look at the US 10-year Treasury yield. This is a good reflection to the perception of growth in the US. It was still fresh in my memory that just 9 months ago, street economists were expecting close to 70% probability that the US economy would experience a downturn in 12 months' time. However, over the last few months, key US data such as non-farm payroll and inflation have been surprising on the upside, and the US 10-year Treasury yield has been edging higher year to date. Currently, it is around 4.6%, and it is possible that it would hit the 5% mark again, which we last saw back in October 2023. The strong growth numbers is powering back the Fed rate cut expectations this year. So this, in turn, lands a bit on the US dollar, especially as the ECB has already signaled a likely cut in June, and the BOJ erring on the side of caution and staying accommodative despite ending their negative interest rate policy. So it is quite likely that the US dollar is going to stay firm in the near term. In fact, I would argue that there is a higher probability that the US dollar is going to stay firm versus gold being able to hold itself around the current levels between 2,300 and 2,400. So why is that? Well, there is an opportunity cost in holding gold, as it is a non-yielding asset. This is especially so if inflation continues to stay sticky, and if the conflict in the Middle East were not to escalate further. Investors would be inclined to take some profit on gold, while the US dollar stays firm on strong US growth prospects, and thus high interest rate differential versus other currencies. So what is the trade here? Well, besides what we discussed yesterday, to buy US equities when the S&P 500 index corrects to 4,800 to 5,000 levels, you may also consider Japanese equities as well, because it seems there's limited room for the Japanese yen to appreciate against the US dollar in the near term. We do like Japan domestic stocks as a foundation idea. However, Japan export companies, on the back of a quote-unquote pinned dollar-yen level around, say, 150 to 153. Now, these export companies are likely to do quite well as a short-term opportunistic idea, especially under a strong growth environment in the US and Japan. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.